So now, the last unit, at least I want to just go over a couple things with you here. We did a lot of this already. We're not going to do the ratios. Next time we meet, I'm going to cover the appendix, which is the conceptual framework, just a little bit because there are some concepts in there that we want to lay out. Conceptual framework has a cost principle, we'll do that, but you certainly have more than enough to do the homework. So let's go through and think about where these accounting principles come from, what are the institutions. And generally accepted accounting principles, or GAAP, will be the standards that are, again, generally accepted by the profession. It's interesting because if any organization, aside from a government agency, issues an accounting standard, and if it's not followed, it's not generally accepted, it goes away. That's what generally accepted means. It's accepted by the majority of the profession. Now, if you look at my definition of generally accepted accounting principles, they are broad reporting guidelines representing the best alternative or alternative methods out of many possible alternatives. These, again, are allowing managers a considerable amount of flexibility and discretion, and they're based on principles that allow for judgment. So the first thing I said today is to make sure you think about accounting as not an exact science. It's going to have a lot of judgment flexibility in its application. Now notice best alternatives. That is a critical statement because there is always more than one accounting treatment for any transaction. So you will always have that income increasing, income reducing alternative. And we talked about the idea of what is best. Example, what is best will change over time. You know, before I started studying accounting, goodwill, which is an intangible, was not amortized or written off. When I started studying accounting, goodwill, the intangible asset, was amortized or written off. Now, in your tenure right now, it's back to where it was before I even started college. So what is best is going to change over time. And you always have more than one alternative method of accounting. Remember, different measurement systems. Some are income increasing, some are income reducing. And again, it is, you might think about the fact that they're only broad guidelines. You know, why then? They're broad guidelines, they change over time, they are based on principles that allow a lot of flexibility. Why do we permit GAAP, or why is GAAP even useful? It does provide external users with some measure of confidence. So it is going to be, at least, when we look at it this way, having a set of established principles are better than having none at all. So when you look at a set of statements, when you look at the audit report, it says it presents fairly in accordance with GAAP and are free from material error, as I mentioned. That is a level of reasonable assurance. It's not exact or 100%, and the GAAP standards that are used to produce those statements at least provide the reader with some basic level of confidence that a group of standards were used to build those statements. Now, this is generally accepted accounting principles that come from many different sources. You might ask, what's the role of the SEC? The Securities and Exchange Commission, and by the way, the market, it's funny because, not funny, but it's interesting and coincidental that when the market crashed in 1929, the use of fair values were rampant. We used fair values and appraisal values in our balance sheets. The SEC came in and prohibited fair values. Now we're back to fair value accounting, and a lot of people in 2008 said, well, maybe we should get rid of it again. Fair value accounting is based a lot on estimates. Sometimes you got a quoted market price. Like if I said, what's the fair value of your stock portfolio? You could open up, your computer, go on, Yahoo Finance and say, here it is. That's what it's worth. So, some fair values have some objectivity to them, but what about using fair values to value a plant? They do that in IFRS, by the way. They get appraisal values to value their buildings. We haven't gone that far yet. SEC, extremely conservative. We'll talk about that a little bit, but they have the absolute authority to dictate accounting principles. They decided to defer to the profession. to the marketplace. So that they still have veto power, they still watch what we do as a profession, but they do not dictate standards. They allow the FASB, which is the Financial Accounting Standards Board, to issue its own standards. And again, publicly traded companies with more than 10 million in assets or more than 500 owners. Basically, most publicly traded companies. Now, what is the private sector role? The FASB is the private sector. It is the Financial Accounting Standards Board. They establish U.S. standards. They followed, historically, they followed the Committee on Accounting Procedure and the Accounting Principles Board. So I can tell you that historically, the way this worked was in 1938, so I just put this over in the corner. I need another eraser. So for about 20 years, you had something known as the Committee on Accounting Procedure, or CAP, and they issued what were called bulletins. They issued 51 of those. The SEC, once the SEC decided that they weren't going to use their authority to generate accounting principles, the American Institute of Certified Public Accountants created the Committee on Accounting Procedure. And this shows up on the CPA exam from time to time. So this is part of the AICPA, American Institute of Certified Public Accountants. Their role was to narrow the number of alternatives and to come up with a set of rules. You don't see much by way of bulletins being quoted because it's essentially an accounting 101 textbook. That's what the Committee on Accounting Procedure did. Then in 1959 to 1973, we had the Accounting Principles Board. And the APB, and they issued what they called opinions. And they issued 31 opinions. Now, some of those opinions are still part of current GAAP. You don't see it as an opinion anymore because it's part of the FASB codification, which we'll see. And then in 1973, to the present, we have the FASB. Now, I'm going to separate this for an important reason. The American Institute of CPAs controlled the Committee on Accounting Procedure and the APB. Around 1971, 72, there was a very similar kind of like market malfunction, very much like what happened to Anderson. A couple of companies were actually, accounting firms were dismantled, and there's always the threat that the accounting principles are going to be turned back over to the government. So the idea is every once in a while somebody in Congress is going to say, hey, let's take all these people in the professional accounting program, hire them as government agents, and have them go out and issue audited financial statements. And we'll pay them through tax dollars that we tax the corporations. That never happened, because right now, don't forget, you come in as an independent auditor, you produce those statements, but where's the problem? The problem is the perception of independence. How could you be perceived as independent? You protect the stockholders in the market, but who's paying you? Who pays the accounting firm?
Company.
The corporation. Yeah, so the corporation pays you to issue an audit report that goes out to the stock market as assurance that their numbers are correct. Now, obviously it's independent. I'm sure we're doing the right thing, but this is the perception the government has from time to time, particularly when there are market malfunctions or problems. So what happened is that when that occurred, they set up the FASB, and there's no association with the AICPA. The FASB, unlike its predecessor boards, is full-time. The other boards were part-time, and the members of those boards were members of public accounting firms. So the argument was, if you're a partner with, in those days, Alexander Grant became Grant Thornton. If you're a partner with Alexander Grant and you're on the APB, you might start thinking, hey, this standard is going to affect my clients adversely, so I'm not going to vote for that standard. So now you have to be totally independent. The FASB operates with employees. You'd have to leave your position with a public accounting firm, totally independent. Not everybody's a CPA. You got college professors, people that work in government, people in finance, economists. They all work on the FASB. They're totally independent. Yeah.
Who elects people into the FASB board?
The FASB, they get appointed. There is a financial accounting foundation, the FAF. They get money. Where do they get money from? Well, they get it from corporations, but nonetheless, that money is used to hire, and they appoint members to the FASB. The FASB is also, you do have certain groups in the FASB that have members of the SEC on certain committees. So you've got a lot of external validation as well. And they issue, by the way, right now, there's something, it's quite different. They don't issue standards anymore. They have a codification. They have an accounting standards codification. We'll get you the access to that codification. You'll need that to do research next summer. The other important point is that now they issue updates. So you'll see accounting standards updates. That's what they issue now. Now, I do feel very sorry for current accountants, because when I took the CPA exam, there were 51 bulletins, which is just basically accounting 101. There were 31 opinions, and the FASB issued 2 statements on the day I took the CPA exam. So I had very little. I got to bring one of these. I'll bring it in. It's like you could probably do them now. Some of you had like accounting in high school. You could probably do some of it. But right now, the technical side of this has exploded. By the time they codified about 5 or 6 years ago. By the time they codified, they were up to FASB statement like 168 or something like that. And it just goes to show you how having an independent board moved more quickly. They dismantled the accounting principles board because they move very slow. I mean, if you just look at this, they're around from 59 to 73. They only issued 31 opinions. That's pretty slow. They didn't move very quickly. And they were accused of putting out fires, like waiting until there was some abuse, and then they'll go ahead and issue a standard. Where the FASB is now moving more toward looking at existing transactions and saying, all right, nothing's wrong yet, but how do we account for it? How do we account for derivatives? How do we account for hedge funds? What do we do in the case of leases? Lease accounting used to be a case where if you wanted to, you didn't have to put the debt on your books. Now you have to. Because they said, companies are going around. Like, how would you like to look at Continental Airlines balance sheet? And they have almost no jet airlines on their plane because they lease them. Right? They have almost no equipment. They have almost no debt. Now that's going to change. So they look at existing principles, and they do a much better job because they are independent. So the FASB right now issues those standards, and they also issue a codification of standards, but they also issue a conceptual framework. That's what we'll talk about a little bit next time around, because it's more of the concepts. Conceptual framework is not GAAP. It's not GAAP, so it does not have any, at all, has no authoritative support, but it provides the framework. All right, so let's stop here, give you a chance to breathe. Now we're going to continue with our learning objective number 4. And what about these standard setters and their relationship to management? What you have to remember is that throughout the course and when you do auditing next semester and when you go out and think about your audit function, management is responsible for the financial statements. So the ultimate responsibility for the statements lies with the management of the company. Management is responsible for all that information, and they're also responsible to ensure that an effective system of internal controls exists. Now, when you think about auditing, did anyone ever work with auditors before in a job? So you know that what do the auditors do? They're generally checking numbers, and that's the way you see it. But actually what happens is that during an audit, the first step is to test internal controls. Yeah. So I'm going to go to your desk and ask you, okay, how do you order inventory? Who approves the inventory order? When the inventory comes in, who counts it? You scan it in. Do you go back to the invoice and make sure that the numbers are correct? Does somebody sign when it's received? Does somebody sign the check? And those are the internal controls that management has to ensure are in place. And what auditors will do is look at those internal controls, they'll examine them. Depending on the strength of those controls, they'll determine how much validation they need to do. So management's responsible for the financial statements as well as responsible for the system of internal control. So they do prepare the financial statements, they do take the ultimate responsibility for those statements, and auditors will examine the internal controls, they'll examine the financial statements, and they will issue an opinion on the statements taken as a whole. These have to be independent auditors, and their opinion will essentially state that the statements present fairly in all material respects. So we would say it's not an accurate presentation, it's not 100% free from error, but it's free from material error. It is an assurance, it's not a guarantee. It's an assurance, but not a guarantee. Now, of course, when you have to think about when people look at auditing and the reason why, in many cases, the government over time has thought about centralizing auditing with the government is that auditors are representing the shareholders, but they get paid by the company they're auditing. So it seems to be an inherent conflict of interest. So, IBM or Microsoft pays their auditors directly, but the auditors are supposed to be, and they will, be independent in all material respects. But again, it's just the appearance. So you'll find out when you look at your auditing that you have to be independent, not only in fact, but in appearance. You have to appear to be independent as well as actually independent. We'll talk about that with auditing. Now, what happened with the significant failures with Enron, and that's when we created the Sarbanes-Oxley. Now, when you look at Sarbanes-Oxley, this came in with the Enron right before, 6 years before the recession, and the Sarbanes-Oxley Act did lots of things. It created a lot of work for smaller accounting firms. So, for example, if you think about PwC auditing a company, they might have been doing tax, they might have been doing the audit work, they might have been doing some of the advisory work, and right now those functions are split. And the article I had up last Thursday about the consulting, we're just starting to bring the consulting back as separate entities from the CPA firms. So what Sarbanes-Oxley did is split a lot of the work. Now, when you start auditing, so you might be working for Markham, or you might be working for Cone Resnick, or you might be working for PwC, you're not the only auditors in-house. So you have lots of audit firms. You might have 2 or 3 audit firms working at the same client. So you don't control the entire audit yourself. And they also developed not only quality, but to increase the confidence that users have in the financial statements. Right now, they created the PCAOB, which is the Public Accounting Oversight Board. And that is Public Company Oversight Board, PCAOB. that body now will issue auditing standards. If you remember, when I was going through the history of the accounting standard setting, talked about this American Institute of CPAs. The AICPA used to be responsible for setting up the boards or committees that issued financial statements, financial standards. They're gone, they don't do that anymore, and they used to be responsible for auditing standards. They don't do that anymore either. It's the PCAOB, the Public Company Accounting Oversight Board, that will approve and issue the auditing standards for public audits in particular. So when you look at this regulation, that's basically the way it's set up. The SEC has the general oversight, but the FASB in the United States is going to issue our accounting standards. The FASB is relatively independent, so you have to remember that the SEC in 1934 was given the absolute authority to dictate accounting standards. They decided at the time that the best way to develop standards was to defer that to the accounting profession. So the profession itself, through the FASB, will create accounting standards. And those accounting standards are used to prepare financial statements. On the other side, it's a little more strict right here because generally accepted auditing standards, or the PCAOB, that is in fact a government agency, and they do issue the audit standards. So it looks like the government is involved heavily on the audit side, and the standard side are still with the private sector in a sense. I guess the FASB, you can look at it as a semi-public, semi-private board, and the FASB does have members of the SEC sitting on certain committees. You find the Emerging Issues Task Force. There's something known as the Emerging Issues Task Force within the FASB. The SEC does have membership on that. And they look at events as they develop and quickly meet and resolve. If there's a consensus of the members of the Emerging Issues Task Force, it becomes part of GAAP. So the FASB does not have to issue a standard. So we'll see a lot more of this in intermediate. We spend a lot more time, but I just want to give you an overview right now of the political framework and the governance of accounting and auditing. Now, just one last thing you have to remember is that obviously there are lots of international companies, and the problem when you have such globalization is that every country's local standards were different. Every country's local standards were different. So as I said, in continental Europe, it was more likely that the standards were based on tax law, so that the government would be able to set up, like in Switzerland or Italy, you got one set of standards locally, they tied in with the tax law, so you really only had one set of financial statements. Then you swing to another model, which is the US-UK type of model, where there's a huge divergence between tax and financial reporting. So in order to make the information consistent across countries, particularly with the trades among the countries of the European Union, the International Accounting Standards Board was developed, and they issue IFRS, International Accounting Standards. These standards are very similar to the US. They don't have a legal authority to impose their standards on any country, but they're very, very similar to US standards, but there are significant differences, and we'll get to those differences. I'll give you one or two right now. For example, in the United States, we use fair value accounting, and I'll bring that up a little bit later in this first module, but we do use fair value for certain assets, like financial instruments, investments. Now, that's not a big leap of faith, because if the market closes today and Microsoft is trading for $120 a share, I can look that up and it's pretty objective, correct? I mean, I don't have too much of an argument. All of us would agree that the value of Microsoft today, or Apple today, is $120. So using fair value in that case is not that much of a problem with respect to reliability. But in IFRS, you can measure your buildings, your land, your factory at fair value on your balance sheet, something we don't do in the United States. We'll see that when we look at, if you read chapter 1, you know that we're predominantly on a historical cost-based system. So there are some differences, and that's one of them. And the textbook will give you some differences as you look at the global perspective sections of the chapter, and some of them are extremely different, but overall, the accounting is relatively the same. And we've been, the United States has been working with the IASB, so the FASB and the International Accounting Standards Board have been working to develop joint standards. And even when they develop joint standards, there's always one provision that is slightly different. You know, there's always one provision, but we are starting to harmonize the standards. Now, about maybe 8 or 9 years ago, it looked like everything was going to be harmonized, 100% consistent, and that's not happening right now. But the U.S. stock markets will accept IASB or International Accounting Standards, so you don't necessarily have to convert your statements to U.S. GAAP. Years ago, you had to convert your statements to U.S. GAAP. So when Daimler-Benz first issued securities on the New York Stock Exchange, they had to fill out a form, an SEC form known as a 20F. A 20F form reconciles German GAAP to US GAAP. And, you know, converting the statements was a lot of work. So now you could use the international standards as well. So they are accepted. A lot of companies are moving to international standards. I know that Ford is making an effort to actually carry a lot of their, because they have international subsidiaries. As I mentioned, if you are auditing, one of your clients could be an international company. If you're auditing, for example, BASF, I mentioned that because it's right near the Jets. I'm always passing it when I go to watch them practice. So they're right there, and they use international standards, and that's something you have to be familiar with. All right, so that takes us through, and that was the end of, I guess, our fourth objective, or fourth learning objective, looking at the structure of the accounting standard setting. Any questions on that, or any comments, or anything you'd like to discuss?